Good afternoon, everybody. I thought we will follow the order where in current situation, borrower has the last say. So it's an honor and privilege to be here to share my views on behalf of the corporate. See, in the opening remarks, you mentioned, Praveen, that there are a lot of corporates which are stuck with the project. It is also true with the operating companies, actually. If we see last 2 years, what has happened is most of these corporates actually have had underutilization, 20%, 30% underutilization. The working capital cycles have become longer. So obviously this has put pressure on the internal accruals, which is the natural source of financing for all the corporates. Now, this shortage in the internal accruals has actually got replaced by bank borrowings because the market also was subdued, equity capital market. So that shows actually there's a huge pent-up demand which is lying there in the corporate to hit the capital market. Unfortunately, the capital markets actually prefer a growth story. You know, nobody would like to go and say that I would like to correct my leveraging, my gearing. That's why I'm hitting the capital market. So most of the corporates would be actually waiting to actually tie up this story along with a growth story. And this will happen only when we see the capacity utilization going up slightly. It may not, people will start picking up their investment proposals, refreshing the memories, and going back to the drawing boards only when they see that another 10-15% of the capacity utilization going up. Some of the corporates who have actually targeted the exports market and tried to increase the capacity utilization, those are the ones which may not have this need to go to the capital market. So this is one, when I say the growth story has to come back when the capital market can be accessed by the corporates. So till then, we'll have to live with this kind of situation. The second G I would mention is actually the global investors. You know, it's an opportunity as well as challenge. Like Praveen mentioned, private equity, there was about $11.8 billion invested last year by private equity in India. That's about 16% jump. But what has also happened is that during last year, the dry powder for India Focus Fund, that has dropped by 40%. And the reasons we know, underutilization of capacity, and the third G, which I would like to say, is governance. The governance both in terms of country as well as corporate. So this has actually, now I'm sure this situation will change in next 2 or 3 quarters when again the growth story will come back and the India focus funds will start seeing more dry powder. So coming to the third G actually, where governance for the country, we know it is now, at least that is, we all hope that it will be taken care of, but it will take another 6 to 12 months before we see the impact on the ground. The governance in terms of corporate, strong boards, strong corporate governance practices are the one which will actually attract money immediately. Those are the ones which are going to attract capital flows first. So both country will attract capital flow as well as corporates which will attract capital flow. Let me cover the second capital raising which Praveen mentioned in his opening remark about the corporate debt fund. Now, just to give you a perspective about corporate debt fund, in South Korea, corporate debt funds account for 77% of GDP. In Malaysia, it accounts for almost 48% of GDP. Whereas in India, it is only 5.54% of GDP. Now, why this is happening is because, again, I call it as 2 Ds here. One is the diversity, and other is the depth. In terms of diversity, on one hand, we have so many regulators who are actually regulating different investors in the bond market. We have SEBI, we have RBI, we have IRDA, we have PFRDA. So different regulators looking at the same investors in the bond market. Second is the, if you see most of these bonds in India, 95% of them are fixed coupon bonds. So these are predominantly only to cover the interest arbitrage to reduce the interest cost. Where is the bond for meeting the cash flow requirement? Infrastructure bonds you mentioned. So there's a huge demand in corporate to also have bonds to meet the cash flow requirement, whether it is project requirement or it could be business cycle requirement. So there's a huge cash flow related bonds which are required. The second D, which is the depth actually, if you see, there are very few issuers, only top rated corporates, there are very few investors, and there are very few instruments. today we are grappling with this issue where the vast majority of corporates are actually getting left out of this corporate bond market. And for them, if they have to reduce the interest cost, the only way left for them is to go and access foreign currency borrowing. And we know what happened in 2008 as well as 2013. The problem comes back to the whole system. So there is, because as long as there's a need for corporates to reduce the cost and there are no adequate instruments available to actually reduce those, they will end up taking this kind of excessive risk. And most of these corporates would actually, Jamal will have many such examples to share how corporates have actually gone topsy-turvy on this kind of risk. And worst part is that they don't even understand the risk which they are carrying. So there's a huge, there's a genuine need for developing a corporate bond market in India. And I came across one interesting article by World Bank, which says that one of the imperatives for corporate bond market to develop is a robust bankruptcy laws. Today, if you see in US, the bond market is so developed and there are high yield bonds. Why can't we have in India? One of the major hurdles which I feel is the bankruptcy laws. Today the retail, if you have to attract retail investors in corporate bond, we can probably incentivize, there are incentives for infrastructure bonds. Why can't we have infrastructure for incentives for other bonds? And what will happen if those retail investors are holding those bonds? There is no robust judicial mechanism for enforcement of contract or handling the bankruptcy issues. So these are my opening remarks. Thank you.
And thank you. So, Venkatesh, you go next, please.
Thank you. Let me at the outset compliment State Bank for doing this wonderfully function where it's a first banking conclave, and I'm also thankful to be invited to be here. Essentially, I think to speak after Anand, Jamal and Azed, and after he has so passionately spoken about infrastructure, I think it's a tough job, but still let me give it a go. Essentially, when we are looking at the whole issues, one is the broader issue of corporate bond market, development of the corporate bond market. The second thing is using the corporate bond market, are we trying to diversify the risk away from the banking system so that the banking system is de-stressed, and with that de-stressed sort of this thing, whether the banking system can in turn use the resources which are being mobilized from the savers for some other purpose, because ultimately the banking system has gone, I would say, whole hog in financing the infrastructure, thinking that the infrastructure is the segment to be in, without understanding that essentially there could be a regulatory risk, there could be even a promoter's risk, there could be a problem relating to the recovery of the loans. All those things are there. Essentially, if we look at the banking sector, the stress is so high with more than around 12-13% of restructured assets in addition to the 5% of the NPAs. So that means somewhere around 17-18% of the money that you have raised and lent, you are not getting it back. And in any case, there are also prudential write-offs, technical write-offs, all those things if we add, it is actually more than 20-22%. So that is where the whole problem is lying, in the sense that we have taken the money from the savers, we have lent it, now we need actually to keep on rolling this so that at least we are able to keep the savers happy. Fortunately for us, the profits, the margins are high, the net interest margins are high. Essentially what has happened is, that is exactly what the Dr. Chakravarti was talking earlier, saying that the net interest margins are very high in India compared to the net interest margins are low in the foreign countries. The risk that the banking system is taking is really phenomenal. So they need actually that net interest margin as a cushion for them. We definitely need, there's no doubts, we definitely need to develop the corporate bond market. There's no two doubts on that. The development financial institutions, like both of us are from the DFI, that is ICICI and IDBI, both of us used to actually issue bonds. If you look at it, the flexi bonds, the deep discount bonds, that has completely vanished after that. If you see the last 10 years, there's no issue from either an ICICI or an IDBI, because after they have converted into a bank, they have not issued anything into the public space at all. if you need to develop the corporate bond market, you need to have good issuers. You need to have investors also. If you are looking at the issuers part, essentially when we are looking at it, we are actually seeing that the top 10 issuers are actually taking away 65% of the corporate bonds that have been issued in the last year. So if you are looking at it from that, only 35% is available for other issuers. And the top 10 issuers are actually, out of that, around 7-8% issuers are issuing tax-free bonds for the infrastructure purposes. So if that is a sort of leeway that the government has given to those people for funding their infrastructure, I fully agree with the chairman when she has told that why can't banks be given the tax-free status in the sense for issuing bonds for funding the infrastructure, because we have already funded so much infrastructure. There is huge amount of infrastructure funding lying in the bank balance sheets. So definitely that is a point that needs to be looked at. The second thing is even senior bonds can be issued. When banks can issue senior bonds, definitely senior bonds can be issued. If you go to Reserve Bank, they will say, we have permitted you to issue senior bonds to the extent of the infrastructure loans that you are given. But then it becomes a very costly sort of resource. So the next best solution that we can say to the central bank is that, okay, please allow us to issue senior bonds. Please don't have a statutory preemption for that. That is in the sense that CRR and SLR on a bond doesn't make any sense, in the sense that you cannot, the customer cannot come and say, please take this bond back and give my money back. You need the CRR essentially for managing your liquidity based on your fixed deposits where premature withdrawals can happen. So why don't you allow issuance of bonds by banks without any statutory preemptions? If they are so much concerned with statutory preemptions to happen, at least then they can say, oh, the residual maturity of 1 year, only to that much extent you maintain the CRR SLR. That is, if, let us say, State Bank of India issues some 30,000 crore worth of bonds, and on the last year, okay, they need to provide for that 30,000 crore at 4% CRR SLR. So that will reduce the cost of issuance considerably, because the statutory preemption cost will come to at least around 1.5%. So you save on that 1.5%, then that at least reduces the cost, and then the bank can lend to the infrastructure at a lower cost, in the sense that the cost of credit which Shika was talking, it will get automatically passed on. So I think the regulator has to look at it. Regulator has to say that essentially we allow you to issue the bonds. Once, let us look at it. If State Bank of India, ICICI, IDBI, or the leading banks start issuing bonds into the market, the retail investors, and that way long-term sort of bonds, the retail investors will definitely invest into that. And then after that, definitely what will happen is, it is a AAA rated bond. Definitely what will happen is there will be trade on that. The secondary market will become active. And when we are talking of consolidation of corporate bond debt, we should look at essentially only the institutional segment can do that consolidation. We cannot expect the corporate to consolidate the corporate debt, for the simple reason, on a single day for him to repay, the bunching up will create a problem. But at the same time, if it is a financial institution like State Bank, ICICI, IDBI, we will definitely be able to raise that much money from whatever is a market at that particular point of time and then refinance that. So I think there is a merit in allowing the banks to issue bonds, and in those bonds essentially to ensure that there is no CRR SLR. If it is given as a tax-free bond, then that is also icing on the cake. But that is one thing which we can look at. If we look at the way in which the capital, we are talking about the capital. Huge amount of capital is blocked, like what Anant is telling on the derivatives, because of netting, all those things, issues, which we have been fighting from FIMDA side also with the central bank. But what I'm trying to say is, you need to raise capital. So whether do you want to raise capital through equity route, or whether you want to raise capital through the debt route. Till, let us say, 6 months back, equity was not at all an option. For the simple reason, the moment you start issuing equity, you are actually destroying the book value. In the sense that existing shareholders' values are getting destructed. So to that much extent, the equity cannot be used as a route for raising. And Government of India, you go to the Government of India and the Government of India gives you the money. This year also they have provided around 11,200 crores in the budget, and still they say that maybe another 8,000 crore can come. So maybe around 20,000 crore, and all the banks will go after government to give the equity support. But I think by doing this, what has happened is essentially the government shareholding in the banks have gone up to such a great extent, including myself, IDBI, we are at around 76% government shareholding. So maybe we need to look at whether we open up so that the government shareholding can come down to the 51%, which is what at least Nayak committee is saying, please bring it below 51%. But when we are looking at below 51%, some of the things that we need to understand is that most of the banks, most of the public sector banks have actually gone abroad to borrow money. They have actually borrowed money, and there are covenants in their loan documents, which say that if the government holding comes below 51%, then definitely there is a call option there. So if that is going to come, and if it is going to come in a bunched up fashion, then it can create a problem, because there could be a cross default clause on your derivative deal. So automatically the cross default clauses gets triggered, and your derivatives also will fall due for payment, all your M2Ms and all those things. So I think we need to, maybe as bankers, I would say that, because the State Bank chairperson is here, I would say that essentially we need to look at it from a different perspective, and also say that maybe 51% is what we will accept. Below 51%, we should not look at this particular point of time for the divestment to happen. And maybe we should look at the bond route, maybe to go ahead and raise money through the bond route. So if you are going for the bond route, whether you can do it through the domestic bond route or through the international bond route. But the domestic bond route, I can say, even for the senior bonds, the bond route itself is not that great. So to go for an additional tier 1, which is a very, very complex instrument, and try to explain to them, it becomes much more difficult. And maybe the government will definitely force some of the institutions to buy, whether the LICs or the insurance companies to buy. But how much can they take? The need for the bank capital is very, very high. So how much can LIC take? How much can the pension funds take? We understand that the PFRDA has already issued the guidelines. When you are looking at the guidelines, we find that essentially, though the guidelines have been put out by PFRDA for the additional tier 1, they have not changed the rating thresholds. So if you are looking at the rating thresholds for investments by the pension funds and provident funds, what will happen is essentially the, let us say a AA sort of bank is trying to issue, a AA bond bank is issuing for a tier 1 bond, you definitely have a 4 notchings down. So if you take the 4 notchings down, then it becomes somewhere around A or A minus. Then definitely that is not worth, it will not come under the investment pattern of the PFs and the pension funds. So that is also another issue which we need to debate. So the outside market is available to us. We need to look at the outside market. So that is one thing which we need to look at it, but it has its own set of issues, which we will maybe discuss at a later stage. I will leave it to Shilpa to add something.
Thank you.
So, staying with your brief, Praveena, I'll interpret capital in 3 different ways maybe. So capital first at a very broad flow of funds into the economy, which our growth trajectory may require. Secondly, as regulatory capital, and thirdly, maybe in a more specific sense of corporate bonds. So first at the very broad capital level, I'll look at it as domestic capital and global capital. I think one very interesting phenomena, if you look at savings rates in India, is that household savings, which is really the bulk of savings for the country, has actually shown almost 2/3 into physical savings, 1/3 into financial savings. So at a very broad level, I think first of all we need to ensure that much more money comes into the financial sector itself. Savings become financial and move away from physical. Now, one might argue that it's really to do with inflation, and because inflation was so high, people were not getting properly rewarded for putting money into financial savings. I think that's part of the reason. I mean, certainly, our economists seem to agree with that. But I think also maybe another reason is the fact that something like a physical asset, land, sometimes has become a currency of its own in the country, and therefore is taking up much of the household savings. So I would say at a very broad 30,000 feet level, the first thing we need to do is get much more money back into financial sector. The other aspect of capital is really global capital. And I think global capital is very interesting in the sense that it's available in plentiful, just at the time when your BOP is balanced and you don't need it. And it's absolutely unavailable when you have a deep hole on trade and current account deficit, and we are looking at various kinds of FDI, FII, corporate bonds, equity, and it's just not forthcoming. So I think that's the interesting nuance about global capital. And I think we need it. I mean, there's no two question. I absolutely agree with everyone over here that given the size of growth which this country needs to hit, there is no question that we certainly need global capital. But for global capital to come in on our terms, so to say, I'm not saying unfair terms, I'm saying very attractive terms, but terms where we're not at the mercy of capital flowing in and out. I think one very basic fundamental fact is we've got to make our current account look strong. And for that, rupee has to be at a level which supports exports. Exports have to be competitive. I think it kind of feeds into the first discussion of the day. We have to be competitive. We have to be in a situation where current account looks okay. And then we need to invite lots of global capital to come in and fund the growth of the country. Moving to the second interpretation of capital, which is regulatory capital, I think most banks are moving into the Basel III scenario. And that's really going to be a tough one because it does make big demands in terms of how much capital one needs to keep aside. But equally, I think we must consider at this point in time that while we're making these demands on capital, we should not allow our banking system to be unfairly also put at a loss to international banking system. So point in case, there is something called illiquidity capital, which is going to be, which is contemplated to be applied for, say, the corporate bond market. So if your corporate bonds are not liquid, if they're not traded on a very active basis, you got to put aside lots more capital to actually trade in them. A second point would be what we discussed on netting, where the rest of the world actually nets derivative exposures and then applies capital. We are taking gross exposures and applying capital. So at a time when capital itself is going to make big demands of the banking sector, if there are inefficiencies in utilization of capital, I think to begin with itself, we are putting ourselves behind the developed world in terms of the capital demands that will be made on us. So that's something I think we really need to discuss and debate and ensure gets done in an appropriate way. Moving on to the final part, so capital in a very narrow sense as corporate bond market. I have two broad comments over here. I think the corporate bond market very beautifully epitomizes the whole discussion about investors and market makers and the need for market makers. This discussion happens all the time, and we often say, do you need a market maker? They are speculators, they are, et cetera, et cetera. But the corporate market actually brings to the forefront the issue of various investors that are there in the Indian market. So you have, we have a pretty big set of investors. So you have provident funds, pension funds, who actually give a home to a lot of these corporate bonds, take them and put them away into their investors' asset pool. You have the mutual funds, you have insurance companies, but I think each of them has a requirement for the bond as an investment held to maturity, which they do in a very good economic sense. But at the same time, because there are not sufficient number of market makers, there is not enough liquidity. When markets are not in a bull phase, you find that there are no takers for these bonds, not easy to exit. And this lack of liquidity then actually curtails the number of people who are willing to come into that market in a much more easy traded way. And that explains why probably even FIIs who are coming in much prefer the no risk GSEC, no credit risk I mean, GSEC market, where it's much easier to enter and to exit rather than the corporate bond market. So I think the fundamental problem with the corporate bond market is really the presence of anchor market makers who will give liquidity during all times in these markets. The very last point I want to make, because lots of times we do think of infrastructure issues on corporate bond markets, and kind of tick off various boxes and say now the bond market should start, moving. Actually, the Dr. Patil committee report, often mentioned, and actually it's been kind of a Bible for most people in the corporate bond space, had very nicely put down what all needed to be done for the corporate bond market to be of a, really good scale and class. And the good news is almost every box in terms of the to-dos that he had put down are almost all ticked. So if you, kind of look at it, periods for, getting your bond going have become shorter, settlement is available, clearing is available, there's an online platform, corporate bond repo, CDS market, you just keep looking at each one and ticking, they're done. I think the trouble there is the last mile issues. So if you look at it, for example, let's take corporate bond repo. You have only one part of the market where regulators have allowed. I think mutual funds, insurance companies, not allowed in that market. If you look at CDS market, it's allowed, but netting not allowed. So that makes it a non-starter for most people because it's just too capital intensive. You look at guarantees for debt of infrastructure companies. That's proposed to be allowed. There's a draft guideline. But there's one little clause which says that nobody who has a loan interest in that company can actually invest, can actually guarantee this bond. Now, a bank which has absolutely no knowledge of a company, has no investment, has no credit understanding of this company, is unlikely to do all of this just for the purpose of, guaranteeing a bond. So there are a lot of last mile issues on each and every one of these, market reforms, which if addressed, I think would make the market a little more interesting. So thank you, Praveen.
Thank you. Jamal, you mentioned about the global crisis not being over, actually. Okay, now that we believe that India has decoupled from the rest of the world or not? So isn't there an opportunity there for India now, actually?
Well, I do believe India has decoupled, but I mean, that is the ocean. You can't decouple completely, So what I'm saying is, as we strengthen, the impact on us of any crisis if it does come will be less, In fact, I'd like to touch on something. One thing you said that I'm not sure I agree with was on allowing global capital into the government debt market. Like, my belief is the reason we didn't really get hit when Lehman went down was because Dr. Subbarao and Dr. Reddy before him were very contained on that score. So while in principle I'm with you that we need the money, but I think I think the regulator's job really is to manage risk. And one more point, sorry I said I wasn't going to say anything, but one of the very interesting things you made when you were talking, you said, I go to the regulator with an idea I have a vested interest, so they take me suspiciously. And a lot of the points you were making also, that a lot of things holding it up appear to be, and I share the view, don't they understand? These are simple things. But I think this is one of the fundamental issues in finding somebody to be a regulator. Because it's very hard to find people who have a detailed understanding and who are not parochial. You are living your life in the bank. You're a sensible, smart guy. So at some level, what works for the bank seems correct to you. I think this is one of the big challenges in the world of regulation, which is why we get caught up so often.
Can I just add to that? Since you picked up that particular point, Jamal, I think there is a kind of a compromise and marriage between what Shilpa said and what you mentioned. I think the starting point is on the dollar inflow side, the capital inflow side. And you're absolutely right. We were insulated from a lot of the crisis because we were not as exposed as some of the other countries were. I think marrying all the points together, starting point is we need the inflows to come in to develop our growth, our infrastructure, right? Now, it comes at a cost, right? But take the example of a bank. When we start a bank, we have to take in deposits. And the point about trust which was made in the first panel, right? So you need that money to come in and to be deployed gainfully, and then the depositor gets paid back. So when you take that money in from an outsider and you need that money, you have to have your basics right. So the point that Shilpa made about getting your current account deficit right, not letting it go up to 5% of the economy as it went in 2013, making sure that the basics are right, which means be sure that if as a bank, if you're having an NPA which is higher than, or a gross NPA which is higher than what the market expects, there could be a run on the bank. So you have to do both. You have to have the inflows coming in, and you have to manage your shop so that nobody ever has an issue of money going out. Or it is in a manner which is